Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is your host, Steve Meisinger. I'm the host of the ISE webinar series, where we bring in special guests. I'm really pleased to have Jack Crooks with us again today. Jack Crooks, of course, is the founder, president of Black Swan Trading, and where Jack talks about, not only does he talk about, but he has a newsletter that has recommendations, tactical recommendations. So a couple things. Number one, I would highly recommend that you sign up for the Currency newsletter. You can do that at his website, and then once you see both he and his son write each and every day, you may want to move on to their paid service where they have trading recommendations. So today Jack's going to be talking about why the euro could disappear. Really, this is going to be something I think you're all going to really enjoy. Jack will go through the slides, and then I'll talk about ISEFX options just for a few moments, and then we'll turn it back to Jack for questions and answers. So Jack, why don't you take it away? I'm really glad that you're with us again today. Thanks so much for joining us.
Thank you, Steve. Thanks again to the ISE for allowing me to do this and share these thoughts and ideas. And just want to say again to everybody, thank you for taking time out of your day to be here. Hopefully I'll provide something interesting, something you haven't thought about before. And I don't think a lot of people think about this topic of why the euro could disappear. Most of us are bombarded each and every day with the thought and the idea, or sometimes the foregone conclusion, that the dollar is going to be the one that disappears and the euro is going to end up being the world reserve currency displacing the dollar. But we just want to lay out a scenario and a framework, really a framework of why we think the euro is structurally unsound based on just its makeup, internal makeup, and why the risks are growing rapidly in this cycle for a possible breakup in the whole European monetary system. So hopefully the rationales make sense. But again, how do we put a probability on this happening? We really don't. I mean, I guess if you had to sit here today and say, is the probability of a breakup in the euro greater than not? You'd probably have to say not. But when you look at the rising potential for a real meltdown, and we're going to show you some numbers that I think will scare you a bit, in the European banking system, besides the other fiscal problems that are developing throughout the Eurozone, I think you'll get a sense of why this is a topic that's been in the back of our head for a while. I can say with honesty, we never thought the euro would last. And I think one of the reasons it's held up so well is because since its introduction back in December of 1998, we've been in a really we had a little bit of a recessionary period in 2000, but since then we've been in an upswing, a major upswing in global markets. And when you're in an upswing and everybody's fat, dumb, and happy and making profits, a lot of problems can be papered over, as we saw with our own financial system. And they were in a very, very big way in Europe, and hopefully we'll try and make that point and why we think the potential is building for a potential breakup here. This is from Milton Friedman. Friedman has been prescient on a lot of subjects. We find Friedman, really one of our favorite economists. Well, not necessarily monetarists, but Friedman had a real sense, I think, of understanding of the difference between a market-driven system and a government-generated system, and could see the inherent flaws in a government-generated system. And the euro really is kind of a currency put together by committee. And really the key points here, from Friedman, he just, number one, was making the point, and he made this statement, around when the euro was being introduced, this idea of a asymmetric shock to the system. And as I said, we haven't seen that shock until now, and that's why the pressures are building inside the system at the moment. He just thought the internal contradictions, and we tend to agree with him. Let me grab a pencil instead of a pen here. The idea of these internal contradictions and we're going to show you what those contradictions are, could tear the euro apart. And we think he's right on that, and we think it's only a matter of time. He also made a statement a few years later. He was interviewed, and I think this is a critical point that people really shouldn't underestimate. There's never been a monetary union put together based on fiat currency composed of independent states. It just hasn't happened and hasn't succeeded in the past. We've had unions based on gold and silver, real hard money, but not on fiat currency. You could probably look at the United States and say that's a monetary union based on fiat currency, but the United States is somewhat different, and we'll show you why. And as I said earlier, we're really now witnessing the first real test of the euro since the introduction. Everything's been going straight up since then, and everybody's been happy. And all the eurozone banking system has been lending out to the gunnels, and their exposure is tremendous now that we've started down the backside of this cycle in a major, what we think is a structural change in the global economy. And it's a structural change because we think the amount of bad debt and exposure in the banking system in Europe is just gigantic, and this is what's going to topple the system. I talked about recently, Steve and I have done a webinar here talking about global rebalancing in the world economy and the breakdown of the export models, and that kind of adds to the heart of this. Germany is in real trouble, and you have to remember Germany is the anchor, is the core of the European monetary system. The German D-mark was the currency in which everybody pegged to in the system initially to create the euro. Germany is in the system, is the core of the system for a lot of reasons, and the system really was created a lot for Germany, and I'll get to that. Before I do that, I want to show you first, this is our disclaimer, saying that anything here is not a recommendation, but just some ideas for you to consider. This is a look of the euro. Since introduction. Introduction, as I said, was back here in December of 1998. Right away, the euro ran down to about 84 cents against the U.S. dollar. And then the dollar bear market started right here in 2001, 2002. The dollar was used to fund a lot of booming assets around the world, and sure enough, the euro just has rallied up to 160. When euro went to 160, it was about 34% overvalued on a purchasing power parity basis. Purchasing power parity is just a thumbnail indication of the purchasing power of currencies across an international basket of goods relative to the dollar. So even so you can see how that just goes to the point that currencies really overrun their fundamentals and overshoot their fundamentals in a very, very big way, and the euro did. The purchasing power parity for the euro is actually around 110. So even though it's broken in here because of the credit crunch and we've rallied back in a big way, needless to say, we think there's a lot of air left in the euro, even on a valuation basis. And if the euro monetary system breaks or somebody suggests that they want to leave the union, we think you're going to see down in here at least very, very quickly. So that's just a look of where the euro started, where it went to initially, and then the dollar bear market started. The dollar bear market was the boom in the global economy, basically. The dollar was the only thing going down, as you can see. The euro, which is representative of everything else, you could have overlaid the euro on oil, you could have overlaid the euro on stocks, and any other commodities, you would have seen a direct correlation. So that move was a liquidity-driven move, and we think had little to do with the actuality of what was going on inside the European Union itself.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.